Okay, we'll go ahead and get started. First of all, I hope everyone had a good break. All 6 of you. Hopefully the break did not consist too much of you thinking about tax. This chapter, Corporate Liquidating Distributions as Tax Goes, is actually, if you've read it already, I don't want to jinx us, but it's fairly straightforward considering how the tax code generally is. So I'm hoping that as far as understanding goes, people will not have too much trouble with the material for this chapter. I've got the slides, and then I've got a few example problems at the end of the presentation that we'll work through. And really, there's pretty much, you're going to follow the general rule for corporate liquidations most of the time. So there are a few exceptions that we'll talk about, but the general rule is pretty simple, pretty straightforward, and you use it most of the time. So it should not be horrifically complicated to understand. So corporate liquidations generally just means that the corporation is basically ceasing to operate and going to sell off all of its assets, liquidate all of its assets, and distribute whatever there is remaining to the shareholders in exchange for all outstanding shares of stock. Okay. We'll talk about this a little bit more later on, but it doesn't necessarily mean that the corporation will cease to exist in name, just that it will cease to operate. Okay. So for whatever reason, when you start a corporation, you've got a corporate charter. You're not turning that in, and necessarily, a lot of people do turn it in and just completely dissolve the existence of the corporation, but that is not necessarily the case. So if you, for instance, want to liquidate a corporation, but you don't want anyone else to then start that corporation up again under the same name but different ownership or whatever, you can liquidate everything, dispose of the stock, and basically cease to operate, but you can keep your corporate charter so that no one else can take that name. Okay. But what most often happens when someone liquidates, a corporation liquidates, they get rid of everything, they cease to operate, and they don't really care if someone else is going to pick up the name or not. So usually they will make it so the charter no longer exists as well. Let's see here. So in general, when a corporation is liquidating, 2 exchanges are happening. The shareholders are exchanging whatever stock that they have. They're giving it to the company, to the corporation, in exchange for assets. Okay, some type of asset. This could be cash, or it could also be just tangible assets that they're getting. Okay, and then the second part of that exchange is the corporation is giving up all of its assets in exchange for stock. Okay, the reason it's important to talk about the liquidation as this type of dual exchange is because for tax purposes, it's still a possibility that we're going to recognize a gain and or a loss on both sides of that transaction. So the corporation could recognize a gain or a loss in its distribution of assets to the shareholders, and then the shareholder also could recognize a gain or a loss in its receipt of these assets in exchange for its stock. And one thing to keep in mind, although this doesn't necessarily happen all the time, is that on the same transaction where the company is distributing assets to the shareholder could recognize either a gain and the corporation also recognize a gain, or the shareholder could recognize a loss, the corporation recognize a gain, or they could both recognize a loss. So it's not dependent. You can't say, oh, the corporation has recognized a gain, therefore the shareholder will also recognize a gain, or therefore the shareholder will have to recognize a loss. You have to look at each scenario on its own. So let's see. Generally, no, we'll talk about that in a minute. So there is this exception here, but we're going to pay more attention to that later down the road. But the exception is when liquidating a controlled subsidiary into a parent. So basically, you've got your parent corporation, and they own 80% or more of the corporation that is dissolving. If that liquidation is taking place where the assets of that subsidiary company are flowing back up to the parent, we don't recognize the transactions. Okay, and the logic behind that is if the parent owns the company anyway, there's not really an exchange taking place. The assets are just going from kind of one part of the parent corporation to another part of the parent corporation. And obviously, you know, if you transfer equipment from one of your plants to another one of your plants, it would make no sense to make that a taxable transaction. So even though the IRS probably would like to tax that, there's no substance or no precedent to make that a taxable transaction. So that's the logic for the exception. So when this takes place, when the liquidation takes place, assets change hands, stock comes back to the corporation. From the standpoint, from the viewpoint of the shareholder, these are the things that we need to know and have an answer for. What is the gain or loss realized? What is the gain or loss recognized? What is the character of the gain or loss recognized? So in the eyes of the shareholder, if they get a gain, is that a capital gain? If it's a capital gain, is it a long-term or is it a short-term capital gain? Same with the loss. Okay. What is the holding period of the property received? So as the shareholder, you get property from the corporation. If later on down the road you sell that property, what do you count as your holding period? So when you're trying to figure out, did I have the asset for longer than a year or not, to determine if it's a long-term or short-term deal, you need to know what your starting date was. Okay. And also, what basis do you as the shareholder get in the distributed property when it comes to you? Do you take over the corporation's basis? Do you get fair market value as the basis? These are the questions that you need to answer from the shareholder's point of view. So for gain or loss realized and recognized, those two are actually going to be the same thing. Okay? From a shareholder standpoint, these will always be the same thing. Whatever gain you realize is the same one that you recognize, which again just means that for tax purposes, you're going to be taxed or receive a tax benefit on that gain or loss when it's recognized. Okay? Realized just means that it happens. Recognized again means that it happens for tax purposes. Okay? So the gain or loss that you realize is the fair market value of the property and cash received minus your basis in the stock. Okay? So if the basis that you held in whatever amount of stock that you had was $50,000 and you got cash and property with a total value of $100,000, then you recognize a $50,000 gain. Okay? So again, you don't care as the shareholder what the basis of the property is in the hands of the corporation. That's meaningless to you. All you care about is the fair market value of that property and what your basis was in the stock that you are kind of having this pseudo transaction where you gave the stock to the corporation gives you the assets. Okay? So this is a pretty simple rule. Whatever your basis is, you know, if you looked at this as kind of an arm's length sale transaction where you're trading someone's stock for this property in cash, this would be logically how you would figure out what your gain or loss was. You'd look at your basis and you'd see the fair market value of what they gave you. Okay. Let's see. Character, usually capital, obviously long-term or short-term depends on how long you held your stock. So if you had your stock for more than a year, whatever the gain or loss is going to be a long-term gain or loss. If you held your stock for less than a year, it's going to be short term. Now the issue that also brings up though is it's not always the case that when you're a shareholder, however many shares you own, you bought them all at the same time. So if you have 10,000 shares of a company stock, but you bought them 1,000 shares per year for the last 10 years, then you need to look at each of those 1,000 share purchases as separate for this purpose. Okay, so you would have, if you had 10,000 shares of stock and 1,000 of those shares was purchased within the last year, within the last year, but the other 9,000 were purchased longer than a year ago, then you would basically look at the gain or loss that you got, and 1/10 of that would be short term, and the other 9/10 would be long term. Okay, so you do have to pay attention to each time that you purchased stock and look at it that way. The holding period is whatever the day after you receive the property is when that holding period starts. Okay, and then again, like I said, you don't care at all about what the corporation's basis was in the stock. So your basis, you don't take over the corporation's basis, but as the stockholder, you will take a fair market value basis in the stock. And that should make logical sense again, because the fair market value is what's determining whether you recognized a gain or loss here. Okay, so those were the shareholder issues. The corporation issues are very similar. I'm going to apologize now. I somehow lost one of my drinks that I brought with me today, so I didn't bring a drink to this class, and my voice gets dry really quickly. So if I cough a lot, you have to bear with me. I might have to take a water break here. So corporation has basically a lot of the same things that you need to know as the same as the shareholder has. Realized gain or loss, recognized gain or loss, character of the gain or loss. But then you also have this other thing that we're looking at here, which is the corporation's tax attributes upon liquidation. So when we talk about the corporation's tax attributes, we're talking about things like tax carryovers from previous years, net operating loss carryovers. We're talking about, when we talked, you had to calculate earnings and profits for the corporation to determine some tax issues. Basically, what happens to all of that stuff when the corporation liquidates? Okay, so that's the main difference between the issues you're looking at from a shareholder standpoint and the issues from the corporation standpoint. Again, gain or loss realized very often, and I would say the general rule is for corporations same as for shareholder, that realized and recognized almost, I would say 90% of the time or more, will be the same. Okay. We do talk about 4 exceptions later on in the slideshow where you will have realized a gain or a loss, but as the corporation, in the corporation's perspective, you won't recognize that for the purposes of your final corporate tax return. Okay, so we'll address those, like I said, later on. Character of gain or loss depends on the underlying nature of the distributed asset. So if it's a capital asset that you're pushing out to shareholders, then it's considered a capital gain or loss from your standpoint. Okay. When we talked again about the corporate tax attributes, those disappear. General rule is any net operating losses, carryovers will go away whenever this liquidation takes place. Okay. And I should have probably touched on the first line there is most important, fair market value of the property distributed minus your basis in that property. Okay, so this is if I have an asset that's worth, fair market value is $50,000 and my basis in that asset, let's say, is $10,000, then it's a $40,000 gain to the corporation. Okay. So I have a question. How does the IRS, or how could the IRS justify taxing this piece of property at the corporate level, and then again at the shareholder level if a situation like that happens, where you distribute $100,000 valued property, basis was $20,000 to the corporation. Okay, so $80,000 corporate gain, IRS taxes that. The shareholder receives this property that has $100,000 value. Let's say their basis in the stock was $50,000. Now on the shareholder side, you've got a $50,000 gain that's also taxed. Okay? So what's the justification? Why would the IRS be justified in taxing that twice? Anybody have an idea? I will, spoiler alert, the IRS doesn't always have to be justified. They can sometimes have stuff that just makes no rhyme or reason. But this one actually makes a little bit of sense. And the justification is kind of this, that taxing it at the corporate level, even though the corporation is dissolving, is a way for the IRS to get at and tax the appreciation of these assets. So as an asset, if you buy an asset that goes up in value the longer that you hold it, as it's going up in value year to year, it's a non-taxable event, right? Just because something goes up in value does not mean that you have to pay the IRS taxes on that item. But if you were then to take that item and sell it after it's appreciated, that's when the IRS usually taxes the appreciation on that item. Because now that it's gone up in value, when you sell it, the appreciation in value is going to be that much more than your basis, and so you'll be taxed on that gain. So this is what we call a built-in gain, and it's a way for the IRS, without making your eyes glaze too much, basically, and this is how a lot of IRS policies start, is there are very smart tax advisors out there that find ways for big corporations to avoid paying tax. As the IRS catches on to these ploys, I don't want to call them ploys because they're legitimate until the IRS makes a rule that says you can't do that. These are legitimate ways of doing things. But that is one way that corporations used to avoid tax in the past, is to buy and sell corporations, not because they want the business or they want to get into that business, or basically for no other reason than to take advantage of these either built-in gains in appreciation of property, or the opposite of that as well, a built-in loss where you have property that's gone down in value a lot, and the corporation buys this other corporation solely so they can use that loss to lower their effective tax rate for these. So this was basically the IRS's answer to avoiding taxation on the appreciation of these assets. So it says, in most cases, we'll just treat it like you sold the asset, okay? Because the sale of the asset is where we made our money in the past anyway. Let's see. If a shareholder assumes a corporation's liability, the amount realized is reduced by the amount of liability, so that should make sense to you. Obviously, if I get an asset from the corporation worth $100,000, but I had to assume a $50,000 mortgage, then that property is not really worth $100,000 to me. It's only worth $50,000 because I still have to pay the bank $50,000 on that property. So also, it wasn't really a $100,000 asset to the company, because if you net together the asset and liability attached to that same piece of property, it's really only worth $50,000. So that's what that first bullet point is talking The second bullet point is one to pay a little bit more attention to, because if a corporation distributes out a piece of property that has debt that's higher than the fair market value of the asset. So this is me distributing out as a liquidating corporation. I'm going to give Hayden a $50,000 house in the ghetto that has a $100,000 mortgage on it. Sound good?
I'm good on that.
Yeah. Now, Hayden doesn't want to do that because what I'm actually giving him is the opportunity to pay $50,000. Nobody views that as an asset, right? Anyone who's, I've tried to get people to pay off my student loans, and nobody wants to do it for me because they don't get anything out of it, right? So what the IRS does is it basically says, if someone agrees to that deal that I just offered Hayden, then there has to be something that we're not seeing. The fair market value can't actually be $50,000 on that house, because otherwise, if that was true, then Hayden would never accept that deal. It has to at least be equal to the debt that he's assuming, or he'd have to be a complete moron to accept the deal. And we know Hayden's not a complete moron, except when he roots for Johnny Manziel. But other than that, he's a pretty smart guy. So this is an example of the IRS kind of taking reasonable person justification and basically saying no reasonable person would agree to receiving an asset that has more debt than it's worth, and so we're going to assume that there's some underlying value that we originally couldn't see or that's not reflected in the market analysis, and so we're going to treat it as if it has value, fair market value of at least the debt that's going into it. So let's look at a pretty simple example here. So you got Y Corp liquidated, okay? Y Corp has shareholders A and B, and shareholder A owns 50% of Y Corp. Adjusted basis let's say $75,000. Fair market value $100,000 of the stock. The equipment that A gets has a fair market value of $100,000. The adjusted basis from the corporation is $20,000. So let's just look at A for now. So shareholder A is concerned with two things: their adjusted basis in the stock, $75,000, and the $100,000 fair market value of the equipment. So shareholder A recognizes what type of gain? How much? Value of $100,000, adjusted basis in their stock, $75,000. What's the difference? $25,000, right? So without knowing, length of time that these were held for, we can't say long-term, short-term, or anything. But we can say that A is receiving a $25,000 gain in this transaction. What about the corporation? Corporation distributed out $100,000 worth of equipment with a basis of $20,000. So we look at the difference between those two, and the corporation recognizes an $80,000 gain. Okay, which means that's $80,000 that's going to be taxed on their final tax return. Okay. Since you see that in this distribution of assets, the corporation is incurring tax liability, it's important to note that all of the non-cash assets need to be disposed of first before you get rid of and distribute all of your cash. Okay? Because the cash that gets distributed out to the shareholders has to at least cover what your final tax bill is as the corporation. Okay? So that's just a food for thought there. So B. B receives a $100,000 piece of land. Adjusted basis is $40,000 in the corporation's hands. Again, fair market value is $100,000 of the stock, $30,000 adjusted basis. So again, fair market value of the stock is kind of meaningless to us at this point. We're only concerned from the shareholders' perspective, the adjusted basis of their stock, and the fair market value of the land they receive. So their gain is 70,000, right? Could be long term, could be short term. Corporation only concerned with these two, so their gain is 60,000. Okay. Obviously, this is a pretty simple example, but this is using the general rule. And since that is most commonly the situation, if you understand that general rule, you're in pretty good shape most of the time. Okay, so let me just say in general, and I think I may have said this before, but my advice for dealing with tax rules is this. You should know and be very comfortable with the general rules, okay? The exceptions are usually a very small percentage of the cases that you'll deal with. So for situations like these, you have the general rule, and then you have these 4 exceptions. You should know that these exist, and you should know enough about the exceptions that if something comes up where you're dealing with a distribution and you see, oh, there may be related parties or related persons here, you should know enough to be able to have a little light bulb go off where you say, oh, I should go make sure what the exceptions were because I remember something about a related person. Okay. Tax avoidance purpose, that's just general general tax knowledge that anything that has a sole purpose of tax avoidance is generally not allowed. Okay? So if you see that as a tax professional, that should be a red flag. Okay? Then you've got property with adjusted basis greater than fair market value contributed by shareholder to a controlled corporation. So, this is basically dealing in situation where you talked about, I don't know if you remember, but we talked about Section 351, where you're contributing property in exchange for stock, and that stock then gives you a 80% or larger share. So that should be, if you've dealt with those types of transactions, this should kind of be maybe I need to look up this exception. And liquidation of controlled subsidiaries should be another light bulb that goes off. Okay, so I'm not going to spend too much time on the exceptions, just enough that you know that these exist and that you are able to just, look them up if need arises for those. Okay. The good thing about tax law is if you remember either the section number that you're dealing with, or some fairly I'd say 3 or 4 keywords of whatever it is you're talking about. If you Google it, it usually comes up in the first 2 or 3 hits exactly what you're looking for. So it's pretty easy to research and look up these items if you forget them. Okay. So distributions to related parties. Pretty much just take a look at the slide there. That should be enough to trigger your brain if that situation or something remotely close to that comes up. And mainly I would pay attention to this bullet point down here, because if you just know that if there's a related party involved in liquidation, hey, I should probably look up the exception. I'm not going to spend any time on that. Again, Section 351 is where you are trading property for stock, and then you have a controlling interest in the property afterwards. This is just policy. Example of an IRS policy rule. They frown on you avoiding tax, right? Which is, it kind of creates this wrong, in my opinion, impression that you're doing something immoral if you are avoiding tax. You're not. If you are legally paying the very lowest amount of money that you owe the IRS, that's what you're expected to do. You're not expected to pay more than you owe. However, when you take on business, I don't want to say business decisions, because your business decisions are always or very often influenced by tax effects. But if the sole reason you do something, that's probably the best way of putting it. If the sole reason you do something for your business is because of the tax implications of that, there's probably a problem. Okay? Doesn't necessarily mean that you're going to get caught or that it will result in some consequences, but if there's no other purpose other than tax avoidance that you can describe for your actions, that's usually a problem. Okay? So that should make the light bulb go off. Yeah, I don't want to spend hardly any time on this. Just knowledge of the general rule for this chapter is most of what I want you to get out of this. Liquidation of a controlled subsidiary. You should always know that the tax rules are not going to be the same when you're dealing with a controlled subsidiary as they are when you're dealing with some other company. Okay, so that should be a pretty easy one for you. Not going to spend a lot of time on these minutia here. You can look at them in the slides. Okay, let's take a look at this. It's the impact of corporate stock liquidation on shareholders. Okay. Again, this is talking about parent. Well, I don't want to spend a lot of time on this one either, because this is again talking about some of the tax consequences of being in that situation where you're a parent company dealing with a controlled subsidiary. Okay. I guess the main point that I would want to make on this slide or on this concept in general is in order to meet the criteria for this, it's found in section 332, for not having to recognize gain or loss if these things happen, where you have a subsidiary that's insolvent. There's a somewhat unique, it's similar to the idea of just having a controlled subsidiary, but there's a somewhat unique definition in section 332 that governs whether or not a parent corporation dealing with a subsidiary is actually considered controlled for these purposes. And it is that you have to own at least 80% of the total voting stock of the subsidiary. Okay, that's not unusual. We talk about it, the 80% rule a lot when we're talking about whether it's a controlled subsidiary or not. The unusual part is that that 80% that you own also has to represent 80% of the total value of all classes of the subsidiary stock. Okay, so adding that little value component to determine whether you qualify under these rules is something that's a little bit different. But for other than that little nuance, basically, and more often than not, if you're an 80% or more owner of a subsidiary, you meet the value rule as well. But I just wanted to make you aware of that. Okay, but if you meet that rule and if the sub company is insolvent, meaning that they have more liabilities than they do assets, then you don't really have to treat it the same way where you're recognizing gains and losses. And then basically the reason behind this is we're basically assuming that as the parent company of this subsidiary, you're the one who's going to end up having to pay these creditors when this liquidation happens anyway. So if you had to recognize that any other way than this way, where you're recognizing the worthless subsidiary stock, then you're basically being abnormally burdened by the IRS. Let's see here. This is, obviously, if you're a controlling corporation and you own 85% of a company, you basically consider that like you own the whole company, but you don't own the whole company. There's still that 15% outstanding. So this is dealing with that 15% of outstanding shareholders, and more or less, we're going to treat them the same way that you would treat normal shareholders in a normal general rule corporate liquidation. Okay? So just because the majority shareholder is a parent corporation and they have these special rules dealing with the subsidiary that's liquidating, that doesn't mean that we're going to change too much the way that we deal with the minority shareholders. So we're basically treating this as if there is no parent-subsidiary relationship that exists in the eyes of these minority shareholders. Yeah, it takes the minutia a little bit farther than I want to. Okay, this picks up on more of the general rule stuff again. How do you know when a complete liquidation has occurred? Like I said, complete liquidation just means all assets have been liquidated and all stock has been redeemed. Okay, but that doesn't necessarily have to be all at once. Okay, these can take place over a period of time. Usually that period of time is limited to a year in most cases. But what's key here is that there has to be this plan of liquidation. Okay? And this plan of liquidation has to be a written plan that basically outlines the fact that this corporation is going to liquidate. If that doesn't exist, then you can't treat the liquidation as taking place until it's complete. Okay? In other words, you don't start treating the distributions of property to the shareholders as being part of this complete liquidation until either you have this written plan in place or it's done and everything is liquidated. Okay? Like we said before, liquidation does not equal necessarily dissolution. More often than not, dissolution occurs at the same time, but dissolution just means surrendering the charter, in which case anyone is free to then go in and scoop up the name of your corporation or whatever and organize it as a new corporation. Okay. So this piecemeal approach to liquidating, like I just talked about, where you have this plan, but it takes place over a longer period of time, that should make sense in that it basically is accomplishing the same thing as liquidating all at once. Okay, so if it's liquidated over a series of distributions, you are allowed to first treat the, like a shareholder is allowed to say, well, these first assets that I'm getting is just a return of my capital. So in other words, it's a return and a lowering of my basis in the stock where I'm getting back this capital. Okay, and that's basically what's happening if the liquidation happens all at once. It's just happening really fast, where you basically are lowering the basis to zero, and once you get to zero, then you're recognizing a gain. Well, if that happens in just one transaction, where the one transaction lowers your basis all the way to zero, and then also contributes to gain, that's really the same thing as if it happened split over 4 transactions, where the first 3 of those transactions cause your basis to be lowered to 0, and the last transaction is fully contributed as a gain. Okay, so they are the same result basically happens from both of those. Important to note as well, though, that losses are not recognized until the full distribution occurs. And the logic behind that should be fairly apparent, because just because you got a loss on part of the distribution doesn't mean that overall the effect of the transaction is going to be a loss to you. And so it makes more sense to wait until the final part of the transaction occurs. Open versus closed is again, and your book really likes to highlight these very unusual exceptions that almost never occur, but just to give you that little bit of extra confusion, I guess. But open versus closed is basically a scenario where you are saying, as the corporation, that you can't figure out what the value of this asset is that you're distributing. And so if there's no way for you to determine the value of the asset, the IRS has said that it's okay to give that asset a value of 0. Okay? But the IRS has also said that basically that's never going to happen. There's almost always a way, some way, to determine the fair market value of the asset. Now, is that fair market value always accurate? No. But basically, just because this exists, this exception, does not mean that it's ever used. I would guess if every single one of you went into corporate tax as your career, I would guess that not a single one of you would ever encounter a situation where an asset was liquidated and you couldn't figure out the value of that asset. Or the IRS would be okay with you saying that you couldn't figure out the value. So I wouldn't pay too much attention to that. So obviously, if a corporation is recognizing a gain or a loss on something, it is recognized in order to account for whatever the taxes are going to be on the final corporate tax return. So that's what I was saying before, where obviously if you're liquidating and as part of that liquidation you're incurring tax liability, you're going to have some ability to pay that tax before all of the assets are gone. So this is where I was saying kind of important to make sure that cash is the last thing that's distributed out to shareholders. So again, this should be fairly self-explanatory, but any type of capitalized expense, and again, when we talk about a capitalized expense, we're just talking about an expense that you incurred at one period of time, but then you are breaking up the recognition of that expense over many years. So if you have any of those capitalized expenses where you're paying or recognizing the expense over, say, 10 years, and you're in year 5 and you liquidate, well, you're basically just going to use up the recognition of that expense all on your final tax return. Okay? So if you have 5 years worth of recognizing that expense, still, that under normal circumstances you would have to string that recognition along for 5 years, you are allowed to recognize the whole expense on your final tax return. One thing that sometimes confuses people with that point, though, is that if you have a capital expense that you're paying on for several years or that you're recognizing over several years, obviously you've already paid that, you're just recognizing it over several years. That's not the same as having a net operating loss carryover like we talked about earlier. The carryover is just a tax attribute that the corporation basically loses when it liquidates, and the expense is something you've already paid, but for accrual accounting purposes or tax law purposes, we're recognizing that on an extended period of time. It makes sense that you should be able to recognize the whole thing. And so you are allowed to do that on your final return. Tax planning considerations. These are just some items that as a tax professional you might want to consider if advising one or more clients on some role that they're going to have in this corporate liquidation. A corporation may want to sell property that's going to end up being a loss instead of distributing it to a parent corporation so that the sub can actually recognize the loss. So again, this is a scenario where you have a controlled corporation and that controlled corporation is going to liquidate, and normally under that liquidation there's property that would go to the parent, but that property, if it was sold in the marketplace, would be able to be used as a loss and a tax deduction for the subsidiary. It may benefit the parent more to have the subsidiary sell that property off, recognize the loss, lower its tax liability on its final tax return than it does to distribute the lost property up to the parent, who then is not able to recognize the loss until it sells the property later on down the road. Okay. One thing to keep in mind when doing anything like this, where you're trying to avoid tax or maximize the value of an asset that you have, is that whatever you do, tax planning wise, it needs to occur before you have the formal liquidation plan. Once you have that formal liquidation plan in place, the IRS treats that as if the liquidation has already started. You also, when advising a client, may want to advise a corporation either to buy or sell stock in the subsidiary so as to either raise them up above the 80% threshold to be considered a parent corp, or down below that threshold, depending on how you want that transaction to play out. So as a prudent and wise tax advisor, you would look at how that would play out if the parent corporation remained a parent, and how it would play out if the parent corporation sold off enough stock to be at 79% and wasn't a parent anymore. You would compare the two options, and then you would be able to give some advice there. And sometimes those differences in taxation can be hundreds of thousands and even into the millions of dollars. So a good tax person is a highly valued asset within a corporation. I want to talk about that. As far as compliance goes, once you adopt a formal plan of liquidation, the clock starts ticking of when you have to file this Form 966 with the IRS that lets them know that you've started this liquidation process. Let's see here. Yeah, and then finally, this is probably the last important tax compliance issue, and that is tax return is due for the year the liquidating corporation is in existence. So until the corporation, the day that that corporation fully liquidates, until that day, that's the last day that they are kind of in existence. And if that day falls in whatever tax year it is, you will have to file a return, for that year. So that first bullet point there is just talking about corporations that don't give up their charter. They're not considered to be in existence if business ceases and all the assets are pushed out. Second bullet point, same thing. Okay, so take a look at this example, and I want you guys to brainstorm with me, and I'm not asking you necessarily to know the answers to these, but what are some of the issues that, as a tax advisor, we should be concerned with in this scenario? from either Bluebird Corporation's point of view or from the stockholders' point of view. What do we want to know?
Fair market value of the buses and equipment.
Okay, fair market value. I agree with that. What else? I'm basically just getting at all of that stuff that was in the 2 slides where I said, these are the issues from the shareholder's point of view that you want to know. These are the issues from the corporation's point of view that you want to know. Holding period of assets, basis in the hands of the shareholder of anything that came to them. Does the corporation have to file a tax return in whatever tax year? Which is Bluebird able to deduct any of the expenses that it incurred when it was liquidating? So that $20,000 of expenses there. What else? If Bluebird is carrying forward or has any tax attributes, net operating loss, anything like that, what happens to that? Basically all of these things that we talked about today. And all of those things are issues that you're going to want to know. You basically don't even really have to look at the facts. You should just be able to know, okay, if it involves shareholders in a corporation liquidating to those shareholders, then you're going to want to know all those things that we talked about. Okay? So I have 2 more example problems, and then we'll be done for today. So Lake Corporation distributes a building used in its business to Sandy in exchange for all of her stock in Lake. Sandy's basis in her stock is $30,000. Property she receives has a $90,000 fair market value. As part of the distribution, Sandy assumes a liability associated with the property of $65,000. The property's basis prior to the liquidating distribution was $25,000. Tax consequences to Sandy and Lake Corporation. So first to Sandy, the shareholder. Is she recognizing any type of gain or loss? And if so, how much? What do you guys think?
Liability is more than she would have gained in $60,000.
So $65,000 liability is greater than what?
$60,000 gain she would have received in the absence of liability.
I agree with that. So what would be gain or loss to Sandy? Loss, right? Of what amount did you say? 5,000. Okay, because of what you said right there, what Dylan said. Okay, $65,000 or the $60,000 gain. So assuming there was no liability, the gain would be $60,000 because there's a $90,000 fair market value of the property, and she had a $30,000 basis in her stock. So that would be a $60,000 gain, but she's incurring this liability, $65,000, so it's a $5,000 capital loss. Is this a scenario where we have to up the value of the property because the liability is greater than the value of the property? No, right? Because the liability is not greater than the value of the property, just greater than the gain that she would have received on that property. So what about in the eyes of the corporation? What do we think? What are we looking at here? Fair market value of the property is $90,000. Liability on the property is $65,000. So if we net those two out, what's the actual value of the property? Now we're not looking at Sandy's basis in the stock here. We're just looking at fair market value of 90,000, liability of 65, 25,000. Okay, so the property is worth $25,000 essentially. And then, all right, let's see here. Sandy assumes liability of 65,000. So property's basis prior to liquidating distribution is 25,000. So what's the gain or loss there? Nothing, right? Because $25,000 basis, $25,000 value basically when you net the fair market value and the liability. So that one just nets out. So again, this is what I was saying, where same transaction results loss to Sandy, nothing to corporation. Okay, last example problem. Under the general liquidation rules, so again, we shouldn't have to be looking at any exceptions here. Kansas Corporation is liquidating, with Sam Topeka receiving $20,000 in cash, plus other property having a $24,000 fair market value. Sam's basis in the Kansas stock is $32,000. What is the amount realized? And I'll say that again. What is Sam's amount realized, and what is the gain recognized on the liquidation? But be careful here, because if you'll notice, I emphasized that the question's asking, what's the amount realized? Amount realized and gain realized are not the same thing. So amount realized, we don't care about whether it's a gain or loss. We just want to know how much in total did Sam get from the corporation. So what was the total value of what Sam got? 44,000. So it's 20,000 plus 24,000, 44,000 total. Okay, and if it's a $44,000 amount realized, did Sam recognize a gain or a loss having a $32,000 basis? Gain of how much? 12,000. Okay, so again, this is pretty simple. When you're using the general rules, it's pretty simple to calculate this stuff. As long as you remember that, because most questions, especially in the book, and I'll throw some of these in the quiz and the test as well, there will be added numbers, like for instance, if I told you how much the fair market value of Sam's stock was, that are red herrings that you don't need to use in calculating the answer. But if you remember that you are, in Sam's perspective, you're looking at his basis in the stock compared to the fair market value of what he receives. As long as you remember that, and you remember from the corporation's perspective, all you care about is corporation's basis in the property and the fair market value of the property, then you should be good to go. Okay, that's the general rule in a nutshell. And then just knowing that these other exceptions exist, and a general idea of red flags to make you search out those exceptions should help you in getting those pieces as well. Any questions on any of this stuff? Okay, that is all for this week. Let me know if you're doing the My Accounting Lab or any other problems working through this stuff. If you come up with questions, let me know, and I will see you next week.